Show. My name is Rob Berger, and tonight is our, weekly 1.5 hour Q&A. As always, appreciate a thumbs up if, you can hear and see me. Hopefully the stream is not choppy. Let's see here. So far it looks good, at least from my end. He's late. I wasn't late, Jeff, was I? I guess by 53 seconds. Well, I was winning a chess game, unlike, by the way, the Ohio State Buckeyes. That might be a topic of discussion for a few minutes this week, particularly if VJ is on. Crispin, thank you for the thumbs up. All right, I'm going to jump right into it. I think this is a really important topic that's just going to take a couple of minutes, and then, you guys can run the show. I was noticing, let me just show you. I'm going to show you 3 mutual funds in Morningstar. And we've seen, I think, all of these. This is just a Vanguard Total Bond Market ETF. Its yield is, we'll call it 4.29%. That's its yield. That's based on the yield. It's an annualized yield based on the last 30 days, or technically it would have been October, I guess. In any event, that's a bond fund, right? Tom from Michigan. This is going to be a long night. Okay, that's the yield, right? 429. So let's go over to VOOV. This is an S&P 500 index fund. The yield is 163, right? And then I want to look at QYLD. This is a covered call ETF. And just so we're all on the same page, what it does is covered call ETFs will either invest like in an index or in individual stocks, and then they'll sell covered calls, which what they do is they sell other investors the right to buy their shares at an agreed upon price, and that right expires. And these are usually shorter term options, but think weeks probably. And the fund gets a premium when it sells the option, and if the prices go up above the agreed upon price, the other party is going to say, "Thank you very much. I'll take them." Pay whatever the agreed upon price was, because if they went up, so they're worth more. On the other hand, if they stay flat or go down, they won't exercise the option. But that's a covered call ETF, right? So if you look at this yield, 1253, I'm looking at the 12-month. I don't know why the SEC yields 43 basis points. I didn't dig in to figure it out. It's not really important for our purposes. The point I want to make here, or for this one, is 1253. That is a huge yield, right? But here's the thing I want to point out. Even though all of these things, here's the bond fund, it's called a yield. Here's the stock fund, it's called a yield. Here's this kind of weird, fund, I'll call it weird, covered call ETF, a yield. Here's the thing to keep in mind. None of these are the same. What's actually behind the yield is very different. They're all called yields. It's kind of like lightning and lightning bugs. They may sound similar, but they ain't, right? So with a bond fund, what this represents is interest, right? That's what this is, interest payments on the thousands of bonds that this fund owns. For a stock mutual fund or ETF, this yield represents a dividend, right? These are dividends that the companies that are represented in this case, the S&P 500, dividends they've paid out. Now, remember, with a bond, the interest is as a practical matter, it's your return. Yes, you can also either gain or lose money as interest rates change during the time you own the bond or the bond fund. But long term, what you're getting is the yield. So this, just to give you an idea, this bond portfolio, I think it's got a maturity of about 7 years. Okay, 6.41. So what the yield tells us today is that if you take the duration and double it and then subtract 1, so that's 9 years, we'll call it, this is basically going to be your annual return. I mean, more or less. So this tells you your return in effect. This does not, right? Because with stocks, we're a part owner. So part of our return not only includes any dividend, but also future growth, assuming there is any, right? And then also what the market is willing to pay for those dividends and future growth, right? Think PE, price to earnings, which fluctuates over time. But the point I want to make is that Yeah, they're both called yield, but they couldn't be. I mean, they're totally two different things. If it's a bond fund, it's interest. If it's a stock fund, it's dividends. If it's a balanced fund, meaning it owns stocks and bonds, then it's a combination, right, of dividends and interest. And that brings us to this fund, the covered call ETF. So what's this 1253? Well, it is in part dividends, right? To the extent, it owns underlying shares or an index that pay a dividend while it owns them, they're going to get a dividend, but we know that's going to be pretty minuscule. What this really represents is the option premiums. The thing about this is it tells you almost nothing about the total return of this fund. In fact, in some ways, one could argue the bigger this is, the worse the fund does. Particularly if there's a lot of volatility, they're getting a lot for options, but maybe the prices are going up and they're getting called away. And in fact, I looked at Portfolio Visualizer. I was comparing, the QQQ and then the QYLD, which is basically a covered call ETF, more or less on the QQQ. And then I was looking at PSQ, which is an inverse QQQ. It shorts that index. And we have data, going back, I think to 2014. And I put in $1 million. And obviously the QQQ crushed the other two, right? The inverse did terribly because other than this year, the market's been up significantly. But because it's been up, this Global X NASDAQ 10 covered call ETF, which got that fat yield, did horribly in comparison, right? So even though the yield looks fantastic, the fund actually has been terrible. Now, this year it is done better than the QQQ. That's what this is. The blue is the QQQ. It's of course lost 30%. The covered call ETF has lost money too, but because it gets premiums and the market's going down, so probably most of those options aren't being exercised. But in any event, they get premiums which offsets some of the losses. The inverse, the fund that shorts the QQQ is obviously done very well this year. But I kind of just wanted to point out that while the real takeaway, and I'm going to do, I plan to have a video out this week on covered call ETFs, but yeah, we look at this yield, but just understand that it represents different things depending on the type of fund, and it has a different meaning, right? Or different significance depending on the type of fund. That was really the only thing I wanted to kind of get across today. Anyone still watching? Few people. Good. All right. Let me just see if anyone had any comments about that. You probably all drifted off a little bit. It's late. I get it. All right. So I had 3 questions before the show started. One was from Mr. Common. He said, if you had to leave an investment portfolio for your grandbabies, what would it be? It'd probably be all stocks. I'm not a huge fan of all stocks, but we're talking 50, 60, 70 years, and it would be a well-diversified, like a VT, which is a Vanguard ETF that basically covers the whole world. It might be 2 funds, so I could determine the U.S. international kind of allocation. Although I don't know that I would, as I think about it, if I were gonna invest today and then I could have no more changes to it, and we're looking at 50, 60 year time horizon, I'm probably not making a big bet on the U.S. I'm not betting against it. And it certainly has some significant advantages over most of the world for a lot of reasons. But yeah, I'd probably maybe just VT. The next question was thoughts on Vanguard's international recommendations, at least 20% of overall portfolio. I agree with that. In international stocks and 30% of your bonds and international bonds. I've not seen where this recommendation comes from Vanguard. I'm not a huge fan of international bonds, mainly because the purpose for me is just to kind of keep things as steady as possible, 2022 notwithstanding. And so for me, treasuries, investment grade, corporate bonds, they're fine. I don't think there's anything wrong, of course, with international bonds. And a lot of the balanced funds, like a Life Strategy fund, is going to have international bonds. I think it's perfectly fine, but I don't know that I'd go out of my way to get them. And then Fast Eddie says, if you were 24 years old, and I can't even imagine that, but If I were 24 and I wanted to retire by 50, how would you invest 15% of your pay in a 401k percentage and Roth percentage? How would you invest 15% of your pay, a percentage in 401k, a percentage in Roth, and a percentage in brokerage? I think that's your question. That's an interesting question. Well, if I assume that those are the only assets that you have, that you're going to tap for retirement, I would certainly max out the 401k and the Roth, because you can get them out. Well, you can always get your contributions out of a Roth. I'm assuming it's a Roth IRA. You can always get your contributions out, so that's not an issue. You can roll over the 401k and then start doing Roth, do a Roth IRA conversion ladder. And if you've retired, presumably your income and therefore your taxes are very, very low. And I'd work to be able to max those out and save in a brokerage. It's probably what I would try to do. I'm not sure how helpful that was. Should we talk about the Michigan game quickly? I should do it. Let's see here. I'm going to engage with my audience. That's what it says. Start a poll. Okay. Should I give my 2-minute evaluation of the game? Yes or no? Okay. I'll let you guys tell me. I'm feeling all Elon Musk, where he asks 15 million people, or whatever the number is, who he should allow back on the platform. Doesn't really seem like I'm not sure that's the right way to go about it. But in any event, I'll ask you guys. 66% so far have said yes. And I think you're just saying that because you want to torture me. I'll let the voting, I'm really hoping the no's will come back strong. So I'll answer one question and then we'll go to that. This is from Josh. Let's say I have a Roth IRA at Vanguard and shares of one stock at another brokerage. If I transfer the stock into the IRA, then later convert it to index funds, can I avoid long-term capital gains? So first of all, how are you going to get it into the IRA? I mean, you can make contributions to an IRA. Those are going to go in the form of cash. I don't think you can contribute in kind to an IRA. If you can, I've never heard of it. And maybe you can, but I don't think so. You'd have to check that out, because I don't know how you'd get it in there without first selling it, which would trigger the taxes you're trying to avoid. And then there may be a way, Josh, but if there is, I don't know. All right, back to the poll. 59% said yes. I don't like you guys. I'm just going to be honest. All right, so here's the deal. We got crushed. Here was the frustrating thing for me. A lot of credit goes to Michigan and their coaching staff and their game plan. I'm clearly biased, but I think it's a fair thing to say that Ohio State is a more talented team, because if you go position by position. Certainly true at quarterback, at running back, and at wide receiver. That's not to say that Michigan doesn't have great players, but O-line, D-line, maybe it's a toss-up. We've got great linebackers. But here was the thing that killed me. We lost the game. Well, coaching's been a problem at Ohio State. They're not a disciplined team, or as disciplined as they need to be. You see it in the penalties a lot, and they hurt them a lot on Saturday. But we lost the game for really just one reason, even beyond coaching. Our defensive secondary was a disaster. The corners were just, I don't even know, did they show up? Here's the thing. At one level, if you looked at stats, the game was kind of even. The time of possession, I think, favored OSU, but it was pretty close. Yards, I think, favored Michigan. I think they had 530. We had maybe 490 something. But think about the 530 from Michigan. 6 plays generated like 350 or 400 of those yards. I mean, we shut them down, except for like 6 plays. And you say, well, yeah, Rob, that's football. Yeah, but those 6 plays, 2 of them, I guess, were broken coverage because the receiver had literally no one around him. It wasn't like, he had a step on a corner and it was a perfect pass. The camera went to the receiver and there were literally no Buckeyes around in the camera shot. That's 2 of them. The very first touchdown Michigan scored, and I was watching this play unfold. It was 3rd and 9. They were on like I'll say their 30. And we have no safeties. Everyone is at the line. And I'm thinking, my first thought was they're going to blitz. They're going to bring the house. Meaning if a receiver gets behind, so when you blitz everyone, including the safeties, the cornerbacks one-on-one have to deal with the receivers. And if a receiver gets behind a quarterback and catches the ball, there's no one to stop him. It's just him in the end zone. And I'm thinking, I get blitzing, right? On the 3rd and 9, you want to reduce the time the quarterback has. Don't give him the time to let the receivers get down the field, to get the first. I get it. That doesn't mean you have to blitz everyone. And so I'm thinking, well, they're not going to blitz everyone, right? They're at the line, they're faking it, but they're going to pull 1 or 2 people back, which is pretty common. You kind of keeping your cards hidden. The offense doesn't know. They think you're going to blitz, but they're not sure. They blitzed everyone, and this is on Knowles, the defensive coordinator. It was an unnecessary risk, and given the issues that the cornerbacks have had, this isn't the first game where the cornerbacks at Ohio State have been a problem. There was simply no reason to take that risk, and sure enough, the receiver. It was close. I mean, in this case, there was actually a cornerback in the shot when the camera went to the catch. I guess that's saying something. But he had to step on the corner, and it's a touchdown. We had same thing. They had 2 long running touchdowns, and sometimes they get through the D line. I get it. Sometimes they get through the linebackers, but you should have a safety there and the corner on that side of the field to make the tackle. Nope. Now that could have been on the coaches. I don't know what scheme they called for those particular plays. But it's just inexcusable. And then there were 2 plays where pass interference, and I get, pass interference happens. No one's perfect, but they were pass interference because the cornerbacks weren't in the right or good position. But when you add all of that up, I mean, we lost the game because of the defensive secondary. That's as simple as that. We controlled a lot of the game. So very frustrating game for me. Okay. It's probably longer than 2 minutes. I really want us to be in the top 4. It's interesting because now there'll be at least a 1-loss team. Ohio State could argue that they deserve to be in there, but I wouldn't even agree with that right now because they lost by so much. And there's probably a view that you don't want 2 Big Ten teams in there. I mean, to begin with, but one of the teams could lose. So I'd love another crack at Michigan. Anyway, that's my take. And, I think we were definitely outcoached. Although I'm not a huge fan. I mean, he's okay, I guess. Michigan's coach. I don't know how great he is. But the thing is, it's a lot more than just the head coach. It's all the way down, the entire coaching staff. And Ohio State's got some issues there. I don't know what they are. Could be Ryan Day. I don't know. Okay, enough of that ugly conversation. Let's see. So Bob wants to know, I'm not sure I'm reading this. I'll show you guys. Here it is. May not have enough in cash for expenses this winter. Sell stocks or bonds, I'm 50-50. Well, Bob, my general approach is to keep, it doesn't have to be exact, but basically keep the asset allocation that I have, whatever my plan is. So if I'm 50-50 stocks and bonds, I'd probably just sell an equal amount of each, right? That's probably what I would do. Is there an argument to do something else? I mean, the only argument to do something else would be, I'm going to sell more bonds or more stocks because I believe over the next months or years, this is going to happen. And that's just not, I just don't think that's a reasonable way to approach it, at least not for me. And there's no way I can be consistently right trying to do that. And as unique as this year is in that bonds and stocks are both down double digits, next year is probably going to be unique too, probably for a different reason. But there's something always like different. Oh, look at this. And you're always going to, at least I'm always going to have this desire to sort of mess with the allocation because of fill in the blank, such and such is going on. And then you get surprised. Someone sent me one of my view of an investment advisor who charges like 155 basis points. So right there, you're out. But his shtick is that he can time the market for you. And he'll give you buy and sell signals, which is just ludicrous to me. And this person apparently correctly called, I guess, the housing crash, and so that's prominent on the website. But apparently they've missed a lot of calls, including they told their clients to get out of the market in March of 2020, which is understandable. I get it. But then, of course, the market went straight up and they missed it all. But he's taken all those down. Those aren't on the website anymore. And it's just emblematic, I think, of that mindset that I can predict the market. And I just don't think we can. I can't. Okay. So let me just take a sip of my tea. Alex wants to know my opinion on index funds or ETFs in a taxable account. I think they're great. I assume we're talking about stock. You've got FXAIX and VOOV. We can look at them. Well, we just looked at, or I said FXAIX. We just looked at VOOV, right? But let's, by the way, I hurt my shoulder, my left shoulder. So I'm a mess. So, okay, FXAIX is just the Fidelity version. So here's the thing you need to keep in mind. If you go to performance, we've done this before, and you go to distributions, you will see whether the fund distributes any capital gains. And you can see back in 2018 and 2019, Fidelity did. Now, I suspect that's a thing of the past, but there's no guarantees. There are no guarantees, right? With VOOV, which is right here, they've never, as far as I know, distributed capital gains. So, picking between the two, I would probably go with VOOV. But again, I suspect FXAIX is not going to distribute capital gains, but I don't know that. Yeah. But they're fairly, that's a fairly tax efficient investment, in my opinion. Marcus wants to know, to achieve a small value tilt, so small companies that are considered value stocks, meaning their price to earnings or the price to book are below average, below market average. Cheaply, what about investing in the S&P 400, 500, and 600? So all three of them? And in international, evenly. Well, VOOV is not international, but FXUS is Vanguard International. We've looked at IJR before, but let's pull it up. So yeah, this is an S&P small cap. Oh, I see what you're doing. I'm sorry. So VXUS is just your international. Got it. VOOV is your S&P 500. IJR is your small cap. And I guess IJH is like a mid cap. Yeah. So I think it's not an unreasonable portfolio. I think the questions I would ask would be, why not replace VOOV, IJR, and IJH with just VTI, a total U.S. market fund? I'm guessing if we looked at it, you wouldn't have the same allocations. I guess that's your point. You want to do this evenly. So you'd want to put 25% in small cap, 25% in mid cap, 25% in large cap. Got it. And then 25% international. So I think that's within it's a reason. It's within the realm of a reasonable portfolio. You just have to understand that you're deviating from the market pretty significantly. And by this, I'm really focused on the U.S. market. And so what that means is there are going to be times when you outperform and, you'll be telling all your friends, let's be honest. Well, I would. Well, not really. But then there are going to be times when you underperform. And the question is, are you going to stick with it? If you tilt your portfolio a little bit, that's true as well, but obviously not to the same degree. You tilt your portfolio a lot, and then that's going to happen. And 25% small cap and 25% mid cap, just to give you an idea, we can look at this to show you the difference. We'll look at VTI, which is total market. We can pull up the portfolio. Here we go. We can go to weights. So it's got what? we'll call it 10%, 9% in small cap. And what you're proposing is 25%, right? This one's not quite as extreme, the mid cap, because they've got 19, you're proposing 25. So again, I guess I'm just pointing out aspects of the portfolio and things that I would be asking myself and thinking about before I decided that's how I wanted to go. Steve wants to know, do you fast or just have an interest in fasting? And what has been your experience? Enjoyed the fasting article from your newsletter. So yeah, for those that don't subscribe to the newsletter, I have a section. So the newsletter, the first 3 articles are usually investing, retirement. Then I link to whatever videos I've published that week. Yeah, my arms. Ugh, okay. And then I have a section at the end where I link to just whatever is interesting to me. I've done a fair amount of intermittent fasting, right? So for me, it's generally don't eat after dinner, and then try not to eat until mid to late morning. I don't get, it's not like I've got a stopwatch and I'm timing this thing out and I've got to have 16-hour fast, although that would be ideal, I suppose. And I did it today. I find it easy if I get out of the house in the morning. I do have coffee in the morning. That's not really virtually no calories in that. But the thing about intermittent fasting for me at this point, it's not about losing weight. One, I sleep a lot better. Well, first, when my shoulder doesn't hurt, but also when I don't eat late at night. And I think I just feel overall better through the day. Now, I don't know if there's any science behind that. I found the article interesting. The aspect of the article that I found interesting was how it can actually help your body repair itself, which that never really, I don't know that I'd seen that before. Now, I don't know how true it is. But anyway, yeah, I don't do long fasts. I don't fast for like a day or longer. I know Tim Ferriss does. And I've listened to his podcast and his experiences about that, which you can check out if that's of interest to you. So Vinyl, how about the real high yield stuff, which uses leverage to buy junk bonds? That just seems to me to be a bad idea. I'm going to just say it there. There's a funny Warren Buffett quote. All his quotes are funny. Let's see if I can pull it up. I don't remember it exactly. Yeah, here it is. So he was quoted as saying, hang on. It's crazy in my view to borrow money on securities. It's insane. Whoops. It's insane to risk what you have and need for something you don't really need. But the quote that I found was funny. He goes, my partner, Charlie, of course, referring to Charlie Munger, says there are only 3 ways a smart person can go broke: liquor, ladies, and leverage. And then Warren Buffett added, now the truth is the first 2 he just added because they started with L. It's leverage. All right. So Adam wants to know my thoughts on SCHD and VOOV to bring more large cap value into an IRA. I like them. I own the Schwab fund. I don't own a lot of it relative to my portfolio as a whole, but it's the Schwab Dividend Equity ETF. And I do view this as a value fund, not a dividend fund, which they're often sort of the same thing. But you can see it's squarely in the value, large cap value. And I don't even know what its yield is. Yeah, it's 340. So that's notably above the market as a whole. And then we've looked at VOOV, although it's been a while since I've looked at it. Whoops, this is a Vanguard fund. And it's just the S&P 500 value. I've not studied this in detail. The thing about this fund, it is, according to Morningstar, classified as value. But you'll notice it's almost a value blend. And I'd rather, if I'm going to tilt towards value, let's tilt towards value. I'm not saying the Schwab fund is the only reasonable approach. And I don't think this is necessarily a bad fund, but I would prefer Schwab for that reason. Now, this one's probably a little cheaper, but they're both cheap. Oh, this is 10. Really? I'm surprised this one's 10 basis points. What is, let's go back here. What's Schwab? This Schwab is cheaper. Huh. There you go. That surprises me. All right. All right, Jeff, let's see. So Jeff says, I have a Vanguard balanced fund in my brokerage account. I've learned that's a mistake because of taxes. What's a safer Vanguard ETF to use if they're all stock funds? By safer, I assume you mean from a tax perspective. Because if it's from a risk perspective, an all stock ETF won't be less volatile than a balanced fund, right? VTV, let's take a look at it. So this is another Vanguard value fund. So here's the deal, Jeff. This is a perfectly good fund. It's cheap, 4 basis points. It's a little more value than the other, the VOOV. I'd prefer this one over the first one we looked at from Vanguard. The thing that I would, though, wonder about is how it fits into your overall portfolio. Like what's your overall asset allocation plan and how does this affect it? That to me is the key question. So for example, if this were going to be the only fund I owned that covered the US, say large cap space, I would pick S&P 500 or maybe a total US market. This kind of fund for me would be if I wanted to tilt the portfolio towards value. So let's just say I had 50, I'll just make it up. I had 50% of my portfolio in US large cap, let's just say. I might put 40% in S&P 500 or total market, I guess, and 10% in a fund like this. That'd be my approach. But the point is, I think this could be a perfectly reasonable fund, but it depends, on all the other pieces of the puzzle that you have. Conscience wants to know how tax efficient the ETFs from BondBloxx in a taxable account. I don't know. It really comes down to the yield, right? And when yields are low, like they have been, they're pretty darn tax efficient. I mean, yeah, it's ordinary income, but they weren't paying much. I guess that's the good side of not making any money. You don't get taxed. Now the yields have gone up, so I would probably prefer to not own them in a taxable account. But that would be true of bonds generally. Now I do own some T-bills, but that's because it's cash that we're going to spend. It's got to be in a taxable account for us. I don't like their website. It's hard to. Oh, here we go. Never mind. I do like their website. I couldn't find it. If I'm looking for. Let's just do the 1 year target duration. What's the ticker? I think these just came out, didn't they? Here it is. By the way, sorry. What I'm looking for is the yield. Yeah, so yield to maturity is 4.75. So it depends how much you have as well, and it depends on your tax bracket. Maybe if people are retired but haven't triggered RMDs yet and don't have Social Security, maybe this kind of thing in taxable accounts not that bad. But all other things being equal, I'd rather not have a yield of 4.75 in a taxable account, particularly one where like this, it's going to be ordinary income. This isn't a government bond, is it? No. Yeah, that'd be my way of thinking through it. So this came up earlier. How do I feel about diversifying bonds globally, active bond funds? If the bond market is so much bigger than the equity markets, shouldn't market efficiency be higher and thus any alpha less likely? Well, that's a question that's above my pay grade. I don't know. I don't feel, as I said earlier, I don't feel a need to have international bonds. Given the purpose they serve in the portfolio, I suppose as the day came when I thought treasuries were risky, although I'm not sure what my alternative would be. In terms of active bond funds, there is this argument that active fixed income can actually produce alpha. And I've looked at that briefly, and I've seen a number of articles that say, yeah, it's really not true. But I can't say that I've done enough research to form an opinion on that topic. And by the way, for those that are like, what's alpha? Sort of like you can get returns that are greater than the market as a whole. One way is to just take on more risk, right? Now, that doesn't get a lot of applause. It's like, yeah, you took on more risk. That's why you did better. It's not because you're a brilliant investor. But what if you could get more and not take on more risk? You might have alpha. The market as a whole, the market risk is they call beta. We go down the rabbit hole in that. That's the whole Markowitz, modern portfolio theory, efficient frontier, all that stuff. All right. So this is a tax question from PH. Just sold my wife's dividend fund for around a $3,400 loss. Can she claim loss on taxes and still rebuy a different fund? So I'm not a tax expert. I mean, none of what I say should be treated as advice. It should be really entertainment, and not much of that. But yeah, why wouldn't you be able to? It's a taxable account. You can deduct, you can offset that. There's short term and there's long term, and but you can offset them against both. Short-term losses first get offset against short-term gains, and then there's any left over long-term gains. If you don't have any gains, you can deduct $3,000 of it off of ordinary income, and the $400 loss would carry forward to the next year. At least that's my understanding. What they giveth in dividend, they taketh away in total return. Or they certainly taketh away in the intrinsic value of the enterprise. Okay. John says, looking forward to your opinion on the housing market. Do you see prices crashing soon? Any pros, cons of buying a house now versus in a year or two? This is, again, one of those things where I don't have a strong opinion. I know a lot of people are saying the housing market's going to crash. Interest rates are still going to go up, maybe slower a little bit now, but they're still going to go up. It's going to eventually affect employment. The housing market's already been affected, and it takes some time to see that, but we're seeing it. And, we have a recession next year, that things get worse, and the housing market's going to, crash or fall significantly. I certainly, by the way, whether that'll happen or not, who knows? I certainly, if I were going to take if I were going to risk this one way or another, I would probably wait unless I had some reason not to. But if I made that decision, I'd have to understand that I could be terribly, terribly wrong. It's just hard to imagine housing prices going back up significantly over the next 12 months or 2 years. Although I don't know, if inflation came crashing back down quickly, I guess anything's possible. You guys don't like my comments about the U.S. Jeff says, never bet against the U.S. Why not? I mean, I'm not betting against the U.S., but we haven't always been the best place to invest. Why do we think going forward we will be for the next 50 years? I don't know. And then Norse mythology wants to know which country in the world is a better investment than the USA. Well, I mean, a lot of countries are certainly cheaper to invest in. Most of them, as a matter of fact. Does that make it a better investment? I don't know. We have our own issues. I mean, we have a growing debt that's going to affect us. Eventually, it's got to, right? But I wouldn't bet against the U.S. either. But I wouldn't also shove all my chips into that one pot. Here's an interesting question. With the fall of FTX and others, I guess BlockFI filed bankruptcy, right? Do you think this will help the stock market as a whole? Less people chasing funny money. Well, if by help you mean raise the price of equities, which one could argue that would hurt the market because things get more expensive. I don't think so. The crypto space, I know it gets a ton of attention. There's a ton of YouTubers with 1 million subscribers, and it's a lot of fun and whatever. It's a tiny, 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 tiny little market. It's insignificant. Yeah. So no, I don't think that people decide maybe crypto wasn't a good bet. We're going to see, tons of money pour into the stock market. I really don't. If we go to Coinbase, they show you the market cap of these coins, crypto. So think about this. The market cap of Bitcoin, I don't know how well you can see that. Let me see if I can make it a little bigger for you, maybe, if I can move my left arm. Look at the market cap of Bitcoin right now, 310 billion. Apple is like 2.7 trillion. Apple, one company. I mean, yeah, and it just goes down, right? I mean, is that the market cap? I guess it's just come down so much because it was over a trillion, but even then, it was pretty insignificant when you think about the market. So, yeah, it's tiny. I mean, a company at 310 billion would be considered I guess that would maybe be a mid cap. I'm not sure. But in any event, it's pretty insignificant. Steve says, a Vanguard advisor thinks international will do better than us over the next 2 years. Do you agree? Well, I have no idea. But it wouldn't surprise me, right? You have to remember, international did better than U.S. stocks over the first decade of this century. And we're definitely going in, we're at higher valuations right now. So eventually international will outperform for some period of time. Whether it will be over the next 2 years, I don't know. More importantly, I wouldn't make investing decisions on that basis. I guess, I could have an opinion, but I really don't have one on that in that score. Okay. This is a comment from Jeff, I think in reference to the Ohio State Buckeye game, and my saying it would take 2 minutes, and he said it shouldn't take 2 minutes. I think that was his way of saying we got routed, and how long does it take to say that? And then Fast Eddie, look at the emoji. This is you guys are not nice. And then look at this. Michigan is greater than Ohio State. You know what stunned me is that we've beat them every year except for the last two for ever. And I didn't realize that. I mean, I knew they had struggled, but I didn't realize it had been that bad. And now they've got 2 years on us, so who knows? Steve is mentioning Archie Griffin. I don't know why. I mean, obviously a former Buckeye, two-time Heisman winner. So Kenny says, nutty times in China. I believe this gets a lot worse and U.S. companies will begin to pull out. Pundits say it's uninvestable. Your thoughts? China needs the world's investment. And, you can have all the political views you want and all of the views on how your society what it should look like and how it should work. But I got to tell you, at the end of the day, it comes down to economics, money. Unless you're going to go, you're going to become a North Korea and just completely isolate yourself from the world with just absolutely tragic results for your people. China's not going to do that. So, I mean, that doesn't say anything about how ugly things might get in the short term. And I followed the whole zero COVID thing and the protests, and so yeah, I mean, anything can happen. But China, at the end of the day, China wants to dominate, and they can't do that without industry. They can't. So I think it'll be very tumultuous. There'll be a lot of volatility in investments in China, but I don't I don't think I don't think long term it's uninvestable. And I could be wrong. All right. So this is a good question from Danielle. 401k stable value income fund paying 325 still makes sense with today's interest rates? No, right? It doesn't. You can do better than that on a savings account. T-bills are over 4%. Now, I don't know the terms of the stable value fund, so maybe I could be convinced that longer term it's maybe not bad. I don't know. But that's actually a low rate. I mean, I think the best savings account rate, not that you could do this in a 401k, but you obviously, I'm sure, have bond funds you can choose. But the best savings account, we'll do money market account. I think it's 4%. I'm just going to my site to look. Yeah, 401 from Brilliant Bank, 4% from American First Credit Union. This is what I'm looking at, by the way. CFG is at 385 and on down. And you can even go to the no penalty CDs are probably better than that. 405, these are save better, but 405, 4. So, and then of course you've just got treasury bills. Yeah. Mike, hello from Texas. Glad you could join us. Thank you for your condolences on the Ohio State game. By the way, I think you're the first to actually offer those to me. Everyone else, I think, was just having a good time. And I didn't even watch the Bengals game. I know that's pathetic. But good. All right. You guys crack me up. Chris says, hey, have the same coffee tea mug. Minnie Mouse. Oh, you have the matching Mickey mug. Oh, but that's valuable. I don't normally drink out of this mug, but it's as you can tell, it's rather large, and this was a 2-bagger, so I had more water. I mean, I got to get through an hour and a half live stream. Although this is caffeine free, caffeine doesn't really keep me up, but I don't normally drink it late at night anyway. But all right, let's see. See, look at you guys. You're mean. Here's Marie. Here's the thing. Ohio State lost. LOL. Oh, and look at Gary. He's getting in. He's piling on. 2 minutes are up. I think that's unsportsmanlike conduct. Unnecessary roughness. Unnecessary roughness. Why does that sound odd? Who else saw the first touchdown? I'm sitting there before the ball snaps, and I'm thinking, where are Ohio State's safeties? Don't tell me you're blitzing everyone. It's 3rd and 9, and Michigan hasn't been able to move the ball. Do it, blitz, I get it. But you're going to leave your cornerbacks to fend for themselves? Really? And sure enough, that's exactly what happened. Oh, this is even worse. You guys, Dinmera, I don't know if I'm pronouncing it. Old men love college sports. So now, not only have you guys beat up on me because of the Buckeyes, now you're calling me old. All right. Well, I guess it's better than the alternative. How about a finance question? Well, this is a good question here from Gabriella. I'm starting out my portfolio and I'm self-employed. How can I diversify my portfolio to retire without a 401k or IRA? Well, there's sort of 2 questions there, I think. Diversifying your portfolio, you can do regardless of the account type. Doesn't matter if it's a 401k, IRA, taxable, right? Have a portfolio that's diversified in terms of stocks and bonds. We talk about these things all the time on the show. Talk about a 3-fund portfolio. There's a lot of different ways to do it. But also, if you're self-employed, which you are, you can create retirement accounts. The easiest one to set up is a SEP IRA, SEP, S-E-P IRA. There's also a solo 401k. I would talk to a tax person to figure out what's best. How much you can put in them depends in part on your profit and what you pay yourself, and also how you're taxed. It's not really that complicated, but I would definitely get someone's advice. So you can create your own retirement account. And my wife and I have a SEP IRA. We've had an old SEP IRA back in the day. We had a defined benefit plan. That's much more complicated. But so you can do that as self-employed. So LTM simply wants to know, what percentage do you hold in bonds and cash? If your investment holdings were your only source of income, would the percentage amount be any different? That's a good question. Well, let me answer the first one. So right now I have about an 80-20 portfolio. So yeah, if it were my only source of income, I might get a little more conservative. Probably not a lot though, but maybe 75-25. In the fixed income, I do have cash in the form of T-bills. So to me, cash would be basically demand deposits, meaning something you could take out anytime you want, or bonds up to, say, a year in maturity. I'd pretty much call that cash, certainly up to 6 months. And so I've been giving a lot of thought of exactly how much cash I want. The cash will always be part of my fixed income allocation, in this case, currently 20%. The question is, how much of that do I want in shorter duration bonds? And it's a little, right now, I've got a little more because we're going to actually be spending some of it next year. But if that weren't the case, I'm thinking 2%. Part of that is based on thinking through like a year's worth of expenses. Again, it'll be but I'll count it as part of my fixed income portfolio, which I think is really important, as opposed to a separate cash account that you don't even factor into your allocation. That would be too, I think, conservative for me. Now, if it were a small amount, a few months, whatever, that wouldn't matter. But anyway, I think I've answered your question. I've tried. I think given the game on Saturday, I'm doing pretty good tonight, all things considered, plus a bum shoulder. And I'm old, according to Maria. Okay. Oh, no, excuse me, Marie. She must be from Michigan. Rick, I don't know. This is getting kind of personal. Wants to know if I receive a pension. I do not. Have you or do you expect to purchase any type of annuity? At the present time, I don't expect to buy an annuity. Don't think I need one, but I haven't completely ruled it out. And I have been doing some research on how to figure out whether an annuity makes sense, and if so, how much you should annuitize. But at the present time, I don't have any plans to annuitize any part of my portfolio. I really dislike the idea of losing control of the money. That's a big thing for me. Okay. Tom says that VJ is probably still celebrating. Probably. All right. So David says, I'm hesitant to not have a person to speak to reach out to at a traditional bank. M1 has a high yield savings account coming in 2023, so I'm tempted to move my banking there. Thoughts? Well, you could do both, right? You could keep your checking account at a traditional bank with a branch down the street, and then put your savings, whether it's M1 or some other online bank, whatever has the best rate or wherever you're comfortable. So you could do both. I've never had a checking account at anything other than a traditional bank. I would be a little nervous about having an online checking account if it were my only one. But I'm not sure I can articulate why, other than there's just some comfort knowing I can drive down to the branch. It's probably partly because I'm an old man. I remember when ATM machines first came out. In fact, those of you that are old like I am will remember, what was it, Sirius and Plus? Were those the two networks? And your ATM card worked with one but not the other. So you'd go to 50% of the ATMs, your card wouldn't work. So Omar, this is an approach that some sort of recommend. Buy a single premium immediate annuity instead of bonds, but that gives you some income floor, and then you have a more aggressive asset allocation. I suppose that could work. One thing you have to think through is that these annuities are not indexed to inflation. So picking the amount you're going to buy gets kind of tricky, particularly if you're younger. So I can't say this is necessarily a bad idea. It's just not one that, at least at the moment, appeals to me. HB, how can I get my adult kids to start investing in the market? I told them to start dollar cost averaging into the employer 401k. Now, 5 years later, nothing, never started. I don't know, but if you figure it out, let me know. I wonder if any of my kids are listening. One of them might be. But that's kind of on me, because we need to look at this child's. Notice I'm not indicating gender so that no one knows who I'm talking about. But we do need to look at this person's 401k. You could, I guess if you really wanted to get them started, you could offer to reimburse them for some of the amount. I don't know. It's a tricky one. I guess one question is, if you talk to them about it, and like, what do they say and why aren't they doing it? And it may just be cash flow, but look at you guys. Here's Here's Q77. I voted yes for the game recap because I needed a bathroom break. That's funny. I don't know, Noreen. Should we kick this person out? We have that authority. It's awfully mean. Okay. It's funny to see these comments like 20 minutes later as I catch up or try to catch up with you. So Howdy wants to know what I think about JEPI. Is that how they say it? JEPI, JEPI. It's a covered call ETF. Dividend safety, taking in consideration its dividend strategy. I don't think about it as, that's a great question. It has nothing to do with dividend safety. So the concept of dividend safety from a company is, what percentage of their profits are they paying out in a dividend? And so if they're paying out, let's say 30 to 50% of their profits in dividend, you might say, well, that's pretty safe because they've got a lot of extra profit that they're not paying out in dividends that they're going to reinvest back into the business. But what if they're paying out 100%? That means they don't have any profit left over to put back into the business. And so there's this idea of how safe is the dividend, right? But with JEPI, these covered call ETFs, yes, there could be a small dividend component based on the underlying investments, but these big yields, as I pointed out at the start of the show, are not from dividends. They're from option premiums. JEPI is a much newer fund, I believe. Here it is. So yeah, it's got a big yield, as you can see here and here. And if we look at performance, I think it's just a year old or 2 years old. Yeah, started in 2020. But the interesting thing to answer your question is, I do think this yield is quote unquote safe in the sense that because it comes from option premiums, it's always going to be there. The problem is the underlying fund, the total return is going to be terrible, in my view. Well, it's going to be better than the underlying assets in a down market, but we know most years the markets are up. I suppose if that changed, but if we think about a world where in most years the markets are down, you probably want to short the market. You don't want to mess around with a covered call ETF, right? That's my view. All right. So Can too wants to know my opinion on investing in an S&P 500 mutual fund, 100% for someone who's 35, not interested in international stocks or bonds for now. Yeah, I mean, a lot of people will do that. I'm not a fan of that approach. I prefer international stocks, as you well know, and you could do 100% stocks if you can stick with it, but yeah, I'd even prefer 10% in bonds. By the way, a 90-10 portfolio can beat a 100% portfolio for a decade or longer. But for me, when I was that age, I also had some small cap value. I had some REITs. I mean, some would argue that the simplicity of what you're proposing is great. I can't argue with that. I don't think that, so I think, yeah, those are my thoughts. There you go. Well, so A wants to know, should they be worried that M1 is going to go under? Even if they recover all their assets, it could be a hassle. I mean, I wouldn't worry about it, I don't think. But I guess I would say if you're worried about it, then just move to a traditional broker. But, traditional brokers can have problems. I mean, you don't ever expect a Vanguard or Fidelity or Schwab to go under. And certainly the odds of that happening are significantly different than a robo-advisor. And M1's not really a robo-advisor, but, these newer companies. I guess part of it depends on why you're there and how, if you're there because of the rebalancing and all of that, and you like it a lot, I would probably be comfortable staying there. But, this is the kind of thing you have to answer on your own. I mean, these are all heavily regulated, right? In the US, broker dealers are regulated. In fact, even at the PCAOB where I worked, we regulated the auditors of broker dealers, as well as the auditors of publicly traded, companies. So there's a lot of regulation. Of course, that doesn't, necessarily prevent bad things from happening. So I mentioned VT. What's my opinion on VT? I think it's a great, simple way to get total, total stock allocation across the globe. I'm not a huge fan of the way it splits US and international. What is it? Is it 65-35, something like that? Let's see. We've looked at this before. I just can't remember. 60-40. I'm not a fan of having 40% in international, but I certainly think, though, this is a reasonable option if you are. There's another one out there, but it's fairly new. Oops, let's try that again. What did I do wrong? Whoops, that's not right either. See, when you've got a bad shoulder, things start to fall apart. Hang on. I can't remember the ticker. That's not right. I'm irritated. I thought it was AVGE. It is. Well, why is did I mistype it? That's weird. Okay, whatever. Morningstar search functionality can get really wonky. This is another one I like a lot. You can look at the portfolio. It's got a value tilt. It's got 28% in international instead of 40. You can see here it's more tilted towards value. It's a very new fund. Well, it's a new fund. You can see it just started this year, but I will say it's a fund of funds. If you go to the portfolio, you can see that. Here are all the underlying funds, and these have been around a little bit longer. I'd say since 2019. Let's see. Yeah, since 2019. So they haven't been around that long either. So that's one thing to think about. But I like this fund a lot, and I've been watching it. But anyway, that's my take on VT. All right. Jeff wants to know if my chess game was what messed up my shoulder. No, honestly, I'm not. We can't figure out what. It's a bit of tendonitis. We don't know what. I have a few ideas. I mean, I've been doing a lot of Pilates and yoga, but I don't know that was it. So yeah, don't really have an answer. Big Tony, I don't think you've joined us in a while. At least if you have, I missed you. But welcome back. What do you think of some cash reserves not needed for 68 years into BND with interest rates slowing down, bonds are still at lows with good yields. I would say over that time period, you're roughly going to get a return equal to its current yield. Roughly. That's my best guess. It's just a guess. And so, if that's meets your goals and needs, I mean, that's what I would expect. Yeah. Depends what you're going to use the money for, what type of account it's in, what all the other investments look like. So there's all kinds of things to think about. And the unknown is whether rates continue to go up or not, right? Because then it could lose some value. But again, you're still going to end up in the 6 to 8 year period, roughly, you're going to end up something close to your yield, I would think, the current yield. All right. Gabby wants to know what happens when a stock distributes a capital gain. Well, I don't think a stock distributes a capital gain. It distributes a dividend. Capital gains come when you sell the stock. Now, a fund can distribute capital gains because if some underlying transactions generate capital gains, that's possible. And yeah, they get if it's in a taxable account, you have to report those. Not unlike if you had sold the shares yourself. And they can trigger both short and long-term capital gains. Now, like most index funds, particularly from Vanguard, and I think now from most big brokers that I've seen or fund families, they figured out how to avoid the distribution of capital gains. But you should look at the history because you shouldn't assume that. But obviously important if you're investing in a taxable account. JP says, I see the large, impressive book titled Derivatives on your shelf. If you haven't already, we do an education form on derivatives. Well, here's the book. And it is impressive. Look at that thing. And I bought it all. And by the way, I have no particular desire to start investing in options. Which is a form of a derivative. But I wanted to learn about it. But this book, I didn't, when I bought it, it's like 900 pages. I didn't realize it was that big. Maybe I need the Cliff Notes. I find it unlikely that I'm going to plow through this thing from page 1 to 900. But yeah, if I ever come to have any strong views on the topic, I'd be happy to share them. Maybe I need a different book. I just got that. So Bullseye wants to know my point of view on the strategy of building a subset of portfolios based on a whole bunch of things. And I don't really, these are a lot of things that I've not dealt with or needed to. I will say though this, the 8+, I wouldn't get excited about an 8% yield. I would get excited about a total return and low costs. But I can't, that portfolio is, it's not within my wheelhouse. All right. Oh, you're saying your yield is 8+%. 8+%, but I don't know what that percentage is. And I would, I'd be interested in the total return, particularly with covered calls. One of the things that I see people do, I'm not saying you're doing this, but they'll tell me, I should follow a covered call strategy. You can't lose because you're going to get your premium. And they always say, set the strike price, sell options with a strike price of say 10% above the current price, maybe a 1 month option or something, 4 week. And that's your worst case, premium plus 10%. I said, yeah, but if the stock goes up 15%, or 20%, I've lost a lot of money. No, you haven't. You got your 10%. Yeah, but I sold an asset for less than it's worth. And it's like, it doesn't register. It's like, these covered calls with ETFs with 12%, yet they vastly underperform a portfolio that just holds the underlying assets with no option strategy. I don't know. Yeah, but it's got a 12% yield. Yes, but you're making less money. It's like someone saying, yeah, I'm going really fast. I'm going 100 miles an hour. But it's like, yes, but you're going in the wrong direction. Okay. I don't know why I get so excited about these things. We could talk about the Buckeyes' loss to the Wolverines, but nah. Well, yeah, if someone needs a bathroom break, I can start talking about that again. Just let me know. Okay. This is funny. Steven wants to know if he can change his vote on the game poll. Depends what your vote was. It's too late. I need to ask another question. I don't know what to ask. I'd written up some questions. Let's see here. I thought I had. Now I can't find them. That's funny. In any event, I need to come up with another poll. Maybe one not about football. So this is from Rob Cathy says, 1.2 million. The AUM, assets under management, is a 1% fee. Average growth is 13.5% for 2 years and a negative 6% year to date, plus a 3% yield, 80-20 value allocation with stocks, ETFs, and bonds. Can I do better with a 3 or 4 fund myself? Well, the problem is I don't know how to answer that question. I think the 1% fee is going to cost a lot of money through your retirement. It's going to lower what you can spend. Whether you would do better on your own than your advisor, I don't know how to answer that. I think it's highly unlikely that an advisor that doesn't just use a low-cost index fund approach will outperform a 3 or 4 fund portfolio over the long term. But there's no way I can say for sure that that's the case. And without knowing what your advisor is doing, average growth of 13.5 is not great. If you go back, if you look at, what is it, 80-20? Yeah, so 80-20. So if we look at, let's see, how can we do this? Let's do, we'll do a VTI of 80%, and we'll do B&D of 20. We'll get rid of this one, and we'll assume a $10,000 investment, and we know 2022 was bad, but let's look at 2020 and 2021 to start with. Whoops, got to put the 20 over here. This is just a 2-fund portfolio. Compound annual growth rate was 19%. Now, your negative 6% year to date is pretty good compared to this portfolio, right? So if we go and just focus in on the current year, it's definitely lost more than 6%, 18%. So, the loss of 6% in a year like this kind of makes me wonder if it's the kind of portfolio that will do better in a down market, but not as good in an up market. In which case, most of the time it will underperform. But again, I don't know that. I don't know the portfolio. Those would all be sort of questions I'd be asking the advisor, I guess, and thinking about myself. And you've also got to ask, how comfortable are you managing your own investments? That's a big question. All right. Sam wants my opinion on fixed versus indexed annuities. Well, these sort of, variable indexed annuities, I'm just not a fan of. They have an underlying insurance component that most people don't need. They're expensive. They'll sell you on this idea that your losses are limited, which may be true, but then your upside's limited too. In some way, they have different ways to limit it. A fixed annuity is almost like an entirely different thing. They're both called annuities, but they couldn't be more different. And I think a fixed annuity can make sense depending on a lot of different, circumstances. I don't, it's kind of hard to dive into anything more than that. I'm not a fan of indexed annuities. Well, here's an interesting question from Scott. Says, how many basis points until you no longer consider an index mutual fund no longer cheap? It depends. So for an S&P 500 or total market, you get above, a couple of basis points and it starts to look expensive. But if you're doing a small cap value or some sort of international fund, you might be at 10 or 15 or even 20 basis points potentially. And I think that would be okay, depending on what it is. My general rule of thumb is I want my entire portfolio to be under 10 basis points. That's my goal. And I think right now I use Personal Capital to track it. I think it's 7 basis points. Sam says, Rob Berger, great entertainment. Thank you. You are welcome. Now, those are the kind of comments. I think everyone else can learn from comments like this from Sam. All right. Well, so here's a good question. Financial advisors feel like a scam. Is there anyone to talk to when you don't know much but have a reasonable amount to invest? Sure. Well, I'm assuming you're saying that financial advisors that charge assets under management feel like a scam. But there are plenty that do a flat fee or do hourly. And let me see if I can find it quickly. I started to create a list. Again, these are not recommendations. You've got to do your own due diligence. But I do have a list of low-cost financial advisors on my website. So if you just Google this, you'll find it. I need to update it. Some of these people I know, some I don't or don't know well. And then down here are lists. Let's see, Cody, who I know, has a list. So he's a financial advisor. The last time I talked to him, though, he wasn't taking on new clients. I don't know if that's changed, but he has his own list. His list looks prettier than mine. That's linked to from my site. And then here's another list. So there you go. So Kat wants to know my thoughts on allocation and retirement, 70-30, 60-40, or 50-50, how best to evaluate. So I think the starting point, the way I think through it is, what percentage of my investments do I need in year one? And assuming you're going to adjust for inflation to at least some degree. If it's near 4%, you need to be somewhere between 50 and 75% equities, at least based on Bill Bengen's research. Of course, all the ones you've suggested are in that range. I think a good starting point for most people is 60-40. And you can ratchet up if you want to, and maybe you don't need a full 4 or 4.5% in year one, or 5%. Maybe you only need 2%. You can take on more risk. But I think 60-40 is a good place to start the analysis from. And it's not an exact science, right? It's not like I can, just based on what seems to work most of the time. And again, we're talking about a traditional retirement length of, say, 30 years. If you're retiring at 35, that's a whole different thing. And if you're retiring at 80, it's different too. You can spend more money in the first year of retirement if you wait till you're 80, unless for some reason you think you're going to live to be 115. All right. There's VJ. Oh, look at that. And he even mustered the strength to put the football emoji. Congratulations, my friend. 2 years in a row. It's going to be a long 365 days. Oh, well. I'm just hoping somehow we get into the playoffs and we get paired and play Michigan. That would be a fun game. All right. Look at all you guys. You're encouraging VJ to be mean. Can't believe that. I know. Fortunately, I know VJ. He is above that. Well, maybe not. All right. by the way, I didn't even watch all of the fourth quarter. It's like games like that. It's like, okay, I'm out. I'm done. I can't. I've watched enough. Knowles, I watched you blitz everybody. I can't take it anymore. I'm out. Okay. Sean mentions a podcast from Ben Miller, who was on the show, right? CEO of Fundrise, on a podcast called Onward. I don't know if Sean is behind that podcast or not, but he's saying that Ben had some great insights. You can check that out if it's of interest to you. I did discuss my title subject line at the start of the show, Bullseye. If you missed it, when the show's over, you can go back and check it out. Okay. Well, Patrick is commenting on my short video today. 2 reasons not to reinvest dividends. He says there's a third reason. Could the reinvest disqualify your tax loss harvest? Oh, that's interesting. Yeah, I guess in theory it could. Yeah. Of course, the short videos can only be 60 seconds. If I'd have thought of that, I wouldn't have had time to put it in. All right. We won't talk a lot about football, but I'm going to say that this is a inaccurate statement. I won't. For those listening on the podcast, I'm not even going to say it out loud. Nor am I going to read this comment out loud. Okay. Is it 8:22? Okay, I'm going to go to the bottom and then work up. By the way, I'm at like 7:40 in the comments. I see some references to Michigan. I just scroll past that. Oh, Sean says he's not behind the Onward podcast. That would have been okay. But anyway, you guys can check that out if you want to get Ben's take on real estate. If you remember from that interview I did of him, my sense was he really knows his stuff when it comes to real estate. Of course, he's the CEO of Fundrise, so you would expect that he would. All right, now I'm kind of working backwards. So Joseph says he's 25, got 10 grand invested, 80% of which is in a Roth IRA. Is this a smart idea, or would you recommend I put more in a taxable account? Well, if you're going to use it for retirement, I love the Roth. I mean, of course, part of it depends on your taxes, your tax bracket right now. Although if you were in a high bracket, it wouldn't necessarily suggest a taxable account. It might suggest a traditional IRA. But putting those issues aside, I don't know why you wouldn't. I think a Roth is a great way to go. Remember, I guess one issue would be if you plan to retire early, but you can always get your contributions out, penalty and tax-free at any time. And there are other ways to get money. In fact, I was going to do a video, and I will, on the different ways to pull money out of a retirement account early, meaning basically before 59 and a half, without paying the penalty. But I can't think of why, assuming it's for retirement, and certainly if you plan to retire on or after 59 and a half. But even if you were going to retire a little early, I suppose if you were going to wanted to retire at 35 or something, you might have to think through exactly how you're going to do it. But put in that kind of extreme situation, or maybe even 45, I suppose. But again, you can take your contributions out. If you're going to really retire at that age, you will have probably put away a lot more than just the max of a Roth IRA. So you'll have different account types anyway. I don't know. I don't see any problem. I can't think of, maybe I'm missing something. Very possible. But if it's for retirement, I think a Roth IRA is a pretty good way to go. All right. What else do we have? You guys are talking a lot about bank rates. Maybe I should talk more about all of this. Someone mentioned Bask. Is it 3.6? Let's take a look-see. So they're associated with American Airlines, right? Yeah, 3.6. They have an account where you earn AA points or miles if you want to, but they just have a standard 3.6. It's not the highest, but it's really good. It's up there, right? SoFi. I probably wouldn't use SoFi. I don't know about SoFi, but they do have I think they're paying 3.5 on checking. The thing is I don't keep a lot of money in checking. And I could be wrong about that. I'm not going to look it up. Okay, now this is helpful. Dave says, great research on fixed indexed annuities, just published in Retirement Income Journal. So I will check that out. Thank you. Here it is. I'll show you guys. I don't know this site, and I don't know the authors, but of course you guys can look them up. I'll look them up. Fixed indexed annuities. What's changed or not in 10 years? You guys probably can't even see this. Hang on. Make it a little bigger. Good. Thank you for that. By the way, I'll show you my process. Not that you guys even care. So the way I would read this, well, I might scan it first to see if this is something I want to keep. Let me take the comment down. I'll just show you behind the scenes. So what I do is I use Instapaper. So I save it to Instapaper. I go to Instapaper. Actually, in this case, my point is to get this into a PDF. I can print a website to a PDF. It doesn't come out well, but this actually has a feature that maybe not all sites do, if it works. Yeah, so I could just do this. And then what I do is I save it to an app called Zotero, which is right here, which is where I keep all research papers, again, any PDF. So it can be a website like we just saw that I convert to a PDF. And the PDF is here. So what I can do, I think this is cool. When I open it up, I use a program called Highlights, and I can literally highlight anything. So I'll just highlight the first sentence. So I can read this and highlight it. I don't know that you guys are interested in this, but I'm going to show you anyway, and particularly after all those nasty Ohio State comments. Okay, so what I can then do is go back here and I can create a note based on my highlights. So here it is, and I just highlighted one thing. But then what I can do is copy this. My note-taking app currently is this, and I'll just put it here. These are sort of lists of portfolios that people want me to review. Once again, I'm just realizing I forgot to do a portfolio this week. Well, I'll do one next week. I'm sorry. Anyway, I can paste this in here. It gives me the authors, any other data that I have in this, so I would add an abstract before I actually pasted it over. But in any event, it puts in the authors, a link so I can go back and look at it in Zotero. And then I can also take the annotations, right? Copy those. And I put them right here. There they are. I have to clean it up a little bit. I get rid of this. But it gives me the annotation, and it usually includes a link to the PDF. I don't know why that didn't come through, but and then from here, when I write about whatever, I'm taking notes about this article, I can link to it from anywhere in my note taking. Like I could have a note, let's say I have a note about annuities, right? I can link to this. They call this a node. I can link to this node. So if I were writing about it somewhere else, I could say fixed indexed, and it creates a link. Of course, I wouldn't do it here because I'm linking to the node that I'm on. And I've just started using all of this and set this up over the last couple of weeks. Really like it. Okay. It's called Tana. You need an invite at the moment. And I had to wait a couple of weeks. It's free, but eventually they'll charge for it. You guys probably don't care. Just, hey, another opportunity for a bathroom break. You're welcome. All right. It's 8:30. Let's go to the bottom and see if there's any one last question. An interesting one. Maybe. Or maybe not. Here's an interesting question. So this is a good question. We'll end on this one. Is it redundant to have an S&P 500 ETF in effectively two different accounts? One, in this case, one's a Roth IRA and one's taxable account. Not at all. The question is, what's your overall allocation? And what role do you want the S&P 500 to play in that allocation? But I have plenty of account types that have the same funds. What I care about is the overall asset allocation, but it's a good question. So yeah, that's in and of itself not an issue. You know, if you think about it, let's just say you have 100 grand and you want 50,000 in an S&P 500 and you have a Roth IRA with 20,000 in it. Well, you can't put $50,000 into an S&P 500 in a Roth IRA that's only got 20. So you put 20 of it in the Roth IRA, if that's your choice, and maybe you've got 30 in your taxable account. So you put the other 30 there, and that satisfies your plan. Again, I've just made up this investment plan, but you get the idea. And I have some funds in like 5 different accounts, the same fund. So yeah, that's a great question. It kind of dovetails with the video I did, what was it, last week, I think, about whether you should think about your asset allocation on an account by account basis, where, like, just as an example, if you were using the 3-fund portfolio, you would create it in each account separately from all the other accounts, you know, so each account would have 3 funds in this example. Or should you sort of think about all of them together, as long as your overall asset allocation matches, say, the 3-fund portfolio, if that's what you're going to do? And I much prefer the latter, just making sure the overall portfolio matches the plan. And that can mean, you know, in the first example where you replicate the 3-fund portfolio in every account, obviously you're going to have the same funds, usually, in all the accounts. But even if you look at it from at an overarching basis, you could have the same fund in multiple accounts, and we do. But then it allows you to zero in on asset location and other things like that. So there you go. That's my take on that one. Well, you know, I think everything being said, I think you guys weren't too hard on me on the Michigan Buckeye game. I suspect it's because I scrolled past most of your mean comments, I'm guessing. I don't know. There were a couple there that were close. It was pretty hurtful, but overall, VJ, I think, well, he's just a good guy, and he you know, he did have the smiley face, but look, he won. I can't blame him. I have a wager with a good friend every year. He went to Penn State, and the winner has to take the loser out for lunch. The theory being, yeah, you lost, but at least you get a free lunch out of it. I keep telling him, he is the most expensive friend I've ever had. I don't know, VJ. Maybe we should have that bet. And yes, the winner has to take the loser out, but the loser has to travel. I don't know, just a thought. All right, everybody. Well, listen, have a great week. Should be back next week, 7 p.m. Monday, Lord willing, and the creek don't rise. And if my shoulder doesn't get worse, hopefully it won't. And so have a great week. And until next time, remember, the best thing money can buy is financial freedom.